Are you prepared to change your financial situation and discover the keys to long-term success? Have you ever pondered how taking charge of your finances and realizing your aspirations could be made possible by understanding fundamental financial concepts? Come along on a financial exploration voyage with us as we explore the top 10 financial concepts that will completely change the way you see money. What if you could at last overcome anxiety and ambiguity about your finances? Are you interested in learning the tactics wise investors employ to amass riches and safeguard their futures? Prepare to explore the depths of personal finance and discover the resources required for success. Estate planning. Making a detailed plan for how your assets and affairs will be managed and distributed in the event of your death or incapacitation is known as estate planning. It includes a variety of legal paperwork and tactics intended to guarantee that your desires are fulfilled and your loved ones are taken care of as per your plans. Creating trusts to manage and safeguard assets, naming guardians for small children, preparing a will to define how your assets should be transferred, and designating beneficiaries for life insurance policies and retirement accounts are all crucial aspects of estate planning. Creating advanced directives such as powers of attorney for financial and medical decisions is another aspect of estate planning that enables dependable people to make decisions on your behalf in the event of your incapacitation. People can ensure peace of mind for themselves and their family by participating in estate planning, which can reduce taxes, prevent probate, shield assets from creditors, and arrange for the orderly transfer of wealth to future generations. Insurance. Insurance is an essential financial tool that offers financial stability and peace of mind to both individuals and businesses by protecting against a range of risks and uncertainties. In return for recurring premium payments, an insurance company assumes the financial risk of any losses. There are numerous insurance policy options available to cover different facets of life and business, such as liability, property and casualty, disability, health, and life insurance. Health insurance offers coverage for medical services, prescription drugs, and treatments in addition to protecting against medical costs. In the unfortunate case of the policyholder's passing, life insurance offers beneficiaries financial help, guaranteeing that cherished ones are cared for. In the event that a policyholder is unable to work due to illness or injury, disability insurance provides income replacement. Insurance against property damage and liability risks, including accidents, natural catastrophes, and lawsuits, is provided by property and casualty insurance. Coverage for legal claims and losses resulting from professional or personal obligations is provided by liability insurance. Individuals and organizations can reduce financial risks, preserve assets, and protect their financial well-being from unanticipated occurrences and liabilities by acquiring insurance coverage that meets their needs. Tax efficiency. A key component of financial planning is tax efficiency, which is reducing tax obligations and increasing income and investment after tax returns. It includes a range of tactics and methods designed to maximize tax results while abiding by applicable tax laws and regulations. Utilizing tax-advantaged investment accounts, such as health savings accounts and retirement plans which provide tax benefits like tax-deferred growth or tax-free withdrawals for certain costs, is one of the fundamentals of tax efficiency. Moreover, tax-efficient investing entails employing tactics like dividend and capital gains management, investing in tax-efficient funds and strategies to minimize taxable distributions, tax loss harvesting, selling investments at a loss to offset capital gains and reduce taxable income, and asset location, placing tax-efficient investments in taxable accounts and tax-inefficient investments in tax-advantaged accounts. Individuals and companies can lower tax liabilities, protect wealth, and improve long-term financial results by putting tax-efficient plans and structures into place. This will ultimately improve overall financial well-being. Retirement planning. In order to accomplish desired lifestyle and income targets in later years, retirement planning is a complete process that includes setting financial goals, predicting expenses, and saving and investing for retirement. It includes a number of components, such as figuring out when to retire, estimating how much income you'll need in retirement, analyzing the many retirement savings options, and creating a plan to save enough money to cover your living expenses in retirement. Participating in employer-sponsored retirement plans like 403(b) or 401(k) plans, funding individual retirement accounts, and looking into other retirement savings choices like annuities and taxable investment accounts are important aspects of retirement planning. Retirement planning also entails creating a retirement income plan while taking longevity, inflation, healthcare expenditures, and Social Security benefits into account. A comfortable and happy retirement lifestyle can be ensured by starting early, making regular contributions, and using tax-efficient investment strategies to develop a retirement nest egg that offers financial security and freedom throughout golden years. Debt management. In order to achieve financial stability and freedom, managing debt correctly and paying it off is a critical component of financial well-being. It includes methods and plans for lowering debt loads, cutting interest expenses, and enhancing general financial well-being. Prioritizing the repayment of high-interest debt such as credit card debt by setting aside additional money to pay off accounts with the highest interest rates first while making minimum payments on other bills is one of the fundamentals of debt management. Consolidating obligations into a single, easier-to-manage payment with a reduced interest rate is another benefit of doing so. Debt burden can also be decreased by negotiating better conditions for repayment or lower interest rates with creditors. Additionally, budgeting making and following one can help with spending management and debt repayment allocation. People may take charge of their finances, lessen financial stress, and work toward being debt-free and reaching long-term financial objectives by putting effective debt management tactics into practice. Emergency Fund. An emergency fund is an essential safety net for finances that offers liquidity and assurance in the event of unforeseen costs or interruptions in income. It acts as a cash reserve or readily available funds set aside expressly to pay for unanticipated expenses like auto repairs, medical bills, or job loss without requiring the use of high-interest loans or depleting long-term savings. A person's monthly costs, income stability, and risk tolerance all play a role in how much money they set aside for an emergency fund. However, most financial experts advise saving 3 to 6 months standard living expenses. Individuals can safeguard themselves against financial difficulties, reduce the need for high-interest loans, and preserve their financial stability by creating an emergency fund and making consistent contributions to it. In the end, an emergency fund contributes to overall financial well-being and peace of mind by giving people a sense of financial empowerment and security that enables them to deal with unforeseen events with fortitude and confidence. Asset allocation. A basic investment technique known as asset allocation is spreading out a portfolio throughout several asset classes, including stocks, bonds, and cash equivalents, in order to minimize risk and maximize returns according to a person's time horizon, risk tolerance, and financial objectives. By distributing assets among a variety of asset classes with varying risk-return profiles, asset allocation aims to lessen the effects of market volatility and possible losses from any one investment. Investors can balance downside protection and growth potential by wisely allocating their assets, maximizing returns while lowering risk. Furthermore, as investors' risk tolerances and financial objectives change over time, asset allocation should be examined and modified on a regular basis. In the end, asset allocation is the foundation of wise investment management since it offers a structure for creating robust portfolios that can endure market turbulence and support investors in achieving long-term financial success. Risk as return. A basic idea in finance, risk versus return, examines the connection between an investment's possible return or reward and the degree of risk involved. Higher risk investments often have the potential for larger profits, whilst lower risk investments usually have smaller potential rewards. This idea captures the fundamental trade-off that investors must make: the readiness to tolerate increased risk and possible losses in exchange for the possibility of bigger returns. Comprehending the relationship between risk and return is crucial for making knowledgeable investment choices and constructing a well-rounded investment portfolio that corresponds with personal financial objectives, investment horizon, and risk appetite. Investors can successfully manage risk and optimize their portfolios to obtain targeted returns while diversifying across many asset classes. This can be achieved by evaluating the risk-return profile of various investment options. In the end, optimizing investment results and reaching long-term financial success depend on striking the correct risk-return balance. Compound interest. The process of generating interest on both the original principal amount and the accumulated interest from prior periods is known as compound interest, and it is a potent financial concept. Compound interest enables investments to grow exponentially over time, in contrast to simple interest, which only applies to the principal amount. Because each interest payment is added to the principal and results in higher interest returns in later periods, the compounding effect quickens the growth of savings and investments. Long-term investments benefit greatly from compound interest since there is a greater chance of exponential development the longer the time horizon. Through consistent contributions and the reinvestment of earnings, investors can effectively leverage the power of compound interest to accumulate substantial wealth over time. Comprehending and using compound interest is a crucial aspect of accumulating wealth, accomplishing financial objectives, and guaranteeing a pleasant retirement. Budgeting. A basic financial technique is budgeting, which is making a plan to control income and expenses in order to reach predetermined financial objectives. It acts as a guide for deciding how much money to set aside for savings, debt repayment, essential needs, and discretionary spending depending on a person's or a family's circumstances. Finding sources of income and projecting costs for housing, transportation, groceries, utilities, entertainment, and savings are the first steps in creating a budget. People can learn more about their financial habits, spot areas for improvement or savings, and prioritize their spending based on their values and priorities by keeping track of their income and expenses. In addition, budgeting aids in maintaining financial self-discipline, preventing overspending, and advancing both immediate and long-term financial goals such as emergency fund accumulation, debt repayment, retirement savings, and financial independence. In the end, budgeting is a crucial component of efficient money management since it lays the groundwork for wise choices, stable finances, and future achievement. Subscribe now to access exclusive financial tips, insights, and strategies that will help you take control of your finances and achieve your goals.